Welcome to another video in this special video series. I'm doing all about how to wholesale and flip houses as a result of the new real estate market caused by the COVID-19 crisis. A lot of changes are happening and it's important you stay up to speed so you can adjust and adapt quickly. And this is the second of many videos addressing one of the biggest challenges facing real estate investors during and post COVID-19, and that is real estate funding for investors. On today's video, I'm going to break down in detail for you the new rules to lending money to real estate investors. Understanding these new lender guidelines is not only critical for fix and flippers, but especially wholesalers. So this is a video you don't want to miss, coming up.
This video is brought to you by 10K Club, a program that pays you $10,000 for finding ugly houses. Learn more at my10kcheck.com.
If you're new here to this channel, I'm Jerry Norton with flippingmastery.com, and this channel is all about ways to help you make money wholesaling and flipping real estate so you can live your dream life. Be sure to subscribe and turn on the bell notifications so you don't miss new videos. This is now the 11th video I've released in this special video series about how to wholesale and flip real estate during and post coronavirus. And it's the second of many videos where I'll be discussing how the changes in funding for real estate investments is one of the biggest challenges facing flippers and wholesalers as a result of COVID-19. Now, the game is changing and it's changing quickly. And my goal is to help you navigate through these unprecedented times so that you can come out victorious. Now, I've created a coronavirus playlist where you can find all of these videos, and I'll put that playlist link in the description below for you. Now, be sure to watch them so that you can stay one step ahead. I can't stress enough how important this topic is. On this video, I'll be laying out for you how the criteria for funding real estate deals has tightened up and exactly what those new lending guidelines are, as well as what you can do as a wholesaler and a flipper to adjust and adapt. Now, if you're unsure why changes in funding affects you as a wholesaler or a flipper, or really any type of real estate investing, then be sure to watch a recent video where I explain how critical the flow of money is for real estate investments and how, as a result of COVID-19, we're experiencing a major disruption in access to capital for deals and how that is going to impact all investors, even wholesalers. Now, if you missed that video or you need a refresher, watch it right now and then come back to this video. I'll put the link in the description below so you can watch that right now. In that video, I talked about how investors who buy, fix, and hold for cash flow, as well as investors who buy, fix, and flip to homeowners, rely on unconventional lending such as hard money and private money to fund their deals. In our industry, we often refer to them as cash buyers, which I admit is somewhat of a misleading title. In fact, Deal Estate Inc. left a comment yesterday and said, "Jerry, you are a flipping genius, but I still have one question. Why do you refer to buyers who need funding as cash buyers? Aren't cash buyers people who have the cash in the bank to quickly buy without all of the issues of getting funding?" Thank you, Deal Estate Inc. That is a great question. And yes, cash buyer is a term used very loosely and can be confusing. Let me answer that question. When investors make offers to sellers, they often say to a seller, "I can buy your house for all cash." Or they'll say, "I am a cash buyer and can close quickly." Even wholesalers say this when in reality, most of them don't even have enough cash to cover the earnest money. Now, technically, Deal Estate Inc., you are correct. Cash buyers should mean that you have liquid cash in a savings or checking account to cover the purchase price, but that's not usually the intended use of that title. What it really means is that the investor, aka cash buyer, does not have a financing contingency. In other words, their ability to fund and close on the deal is not contingent or dependent on getting approval from a lending source. What that means is if a cash buyer doesn't perform and close on the purchase according to the terms of the contract, he is subject to the ramifications of a breach of contract, which usually means he would forfeit his earnest money. Now, this is the opposite of a financing contingency, which is common with retail buyers who are getting a bank loan, which states that in the event the buyer does not obtain financing to purchase the property, he can terminate the contract without suffering any consequences. So the term cash buyer does not necessarily mean that he has stacks of cash in a suitcase under his mattress at home. And because the term is confusing, what I do to make sure that I'm not misleading when making offers is I say the following: "Mr. Seller, me and or my investors can buy your house all cash." That means we don't need to get bank approval to qualify to purchase your home. It means we have access to the funds to buy your home as is and can close quickly and on schedule. Now, using this specific language with sellers allows me to have integrity and not be misleading. First of all, by saying me and or my investors sets me up to wholesale because my investors is referring to other cash buyers that I'll wholesale the deal to if I'm wholesaling. And explaining to a seller that when I say cash buyer, I'm specifically referring to unconventional funding to be able to buy the home as is, and that my ability to perform is not contingent on bank approval. Now, this now sets me up to use hard money and or private money to fund the deal. Using this language is being honest, while at the same time, it helps the seller feel comfortable that you can perform, which ultimately is what he cares about the most. And as you can see, these clarifications, however subtle, are powerful, and I recommend you implement this language immediately in your scripts. By the way, if you'd like my scripts I use with sellers for free, just go to freesellerscripts.com. Now, the reality is most investors rely on leverage to do deals, which is why investment funding is so critical for the world of real estate investing to function properly, and why it's such a big deal right now that funding is tightening up due to COVID-19. Now, let me take a minute and explain how leverage works, and then we'll discuss the new lending criteria. For most real estate investors, even if they have their own accessible cash sitting in a checking account, using 100% of their personal funds to do deals may not be a good idea because eventually they'll run out of money or they'll be limited on the number and size of deals they'll be able to do. Utilizing other people's money to do deals is called leverage. For example, let's say that you're a fix and flipper and you have $100,000 in cash burning a hole in your pocket that you want to use to do a fix and flip deal. And let's say that in your market, you can find deals for $75,000 to purchase that need $25,000 in repairs for a total of $100,000 in capital or money to do the deal. Now, you could use your $100,000 in personal cash and do one deal at a time. So if it takes 6 months to do a fix and flip deal, then you could use your $100,000 all cash to do 2 deals per year. Or you could leverage your $100,000 and instead of doing 2 deals a year, you could do 8 deals a year using the same $100,000. Here's how. Instead of funding your one fix and flip deal with 100% of your capital, you could get a specialized short-term rehab loan called hard money that would fund you 75% of the capital to do the deal. By doing that, you're leveraging other people's money by only using 25% of your $100,000 cash for the down payment and then getting a hard money loan for the remaining $75,000. That means assuming you could find additional similar deals, you could leverage your $100,000 for down payments and do 4 fix and flip deals at a time or 8 in a year if they took 6 months to flip. Most investors understand the power of leverage and they utilize hard money and or private money to fund their deals. And just so that we're clear on the difference, hard money is institutional. It's a fund or a pool of money that is used to lend out to flippers and buy and hold investors. The way a fund works is passive money investors put their money into the fund at, let's say, a 5% preferred rate, and then the hard money institution lends that money to fix and flippers at, let's say, 12%, and they make a 7% gross spread on the money. Private money, on the other hand, is an individual who lends his or her own money on real estate deals. It's their personal money and a loan from the private money lender directly to the fix and flip investor. Having said that, let's talk about the criteria that most lenders use and how that criteria is being drastically affected by COVID-19. Now, a money lender's model is to balance risk with return on investment or ROI. They understand that lending money on investment projects is risky, so they do their best to mitigate that risk while at the same time earn a higher return for taking that higher risk. Let's discuss some of the risk factors that are considered, but keep in mind, I'm generalizing here because every lender is going to have varying degrees of risk tolerance and return goals, but this will help you understand the major factors considered. First is location. Many lenders are very particular about the location and have specific areas they will lend and areas they deem too risky and won't lend. I like to ask lenders their favorite locations within a market. This lets me know where they think the hottest locations are. As a wholesaler, the less desirable the area, the harder it is for an investor to get funding for it. The second factor a lender considers to mitigate risk is the size and scope of the project. Some lenders just want to lend on a light or average rehab project, and they stay away from the really heavy projects such as additions or redesigns or homes that are gutted. Now, as a wholesaler, the bigger the project, the harder it is for an investor to get funding for it. The third factor a lender considers to mitigate risk is the after repair value threshold. Now, some lenders are comfortable doing higher end homes, but many are not. Since I personally love the high-end markets, I work with a niche lender that specializes in lending on homes over $1 million. But they are the exception, not the rule. Most do not lend on luxury homes. Now, I know another lender who does not lend on deals that are over $500,000 ARV. The same is true on the low end. Some lenders do not lend on properties valued under $100,000. As a wholesaler, you need to understand that the fringes are harder for investors to get funding on. The fourth factor a lender considers to mitigate risk is equity. Now, a lender needs to know that in the event of default, they can foreclose and fire sale the property and be made whole on the loan. Now, as such, they only want to lend a certain percentage of value. There are two values that they consider. First is the after repair value or future value, and the second is the current as is value. For example, a lender may require an 80% loan to ARV and a 65% loan to current value. That leaves enough equity for them to feel safe in case they have to take back the property. Now, as a wholesaler, deals that are outside the equity requirements on lending are harder for investors to get funding. Now, let's talk about the borrower. The fifth factor a lender considers to mitigate risk is a borrower's down payment. Now, we often call this skin in the game. The more a borrower puts down, the easier it is to get funding. When times are good and markets are appreciating, lenders loosen up down payment requirements. Pre-COVID-19, I've been getting 10% down hard money loans. And in a minute, I'll explain how those days are long gone thanks to COVID-19. As a wholesaler, know that cash buyers that can't put at least 25% down, maybe even more, are going to have a hard time getting funding for your deals. Now, the sixth factor a lender considers to mitigate risk is a borrower's experience. Now, it goes without saying that the more experience you have flipping houses, the easier it is to get funding. Many hard money lenders will lend to first-time flippers, but they will more than likely require more down and charge higher fees. Now, if you're new, just accept it. It comes with the territory. You have to start somewhere. As a wholesaler, just know that the less experience your buyer has, the harder it is for him to get funding. Okay, the seventh factor a lender considers to mitigate risk is a borrower's liquidity or cash on hand. Many lenders want to know that the borrower is producing enough cash or has enough revolving balance in the bank to cover the monthly payments to service the debt. That means as a wholesaler, the less cash on hand investors have, the harder it is for them to get funding. And the eighth factor a lender considers is a borrower's creditworthiness. Now, not all lenders look at credit score and credit history or require it, but certainly if it's strong and the borrower is willing to use it, a lender will be more willing to lend them money. After considering all of these different risk factors, an investment lender weighs them against their return on investment, and naturally, this type of financing is more expensive. There are three basic fees an investment property lender charges. The first and the most obvious is the interest rate. Now, pre-COVID-19, where risk was low and a ton of money was pouring into real estate and unconventional funding such as hard money was everywhere and it was easily accessible, this created a lot of competition and this drove down rates. Now, typically hard money for fix and flip loans costs around 10 to 12%, but I was getting rates in the single digits, which is just unheard of. Now, the second fee lenders charge to increase their ROI is origination fees, commonly referred to as points. Now, these are fees paid upfront just to place the loan. 1 point is equal to 1% of the loan amount paid upfront as a lump sum fee. For example, if the loan is for $100,000 and the lender charges 3 points, the borrower would pay 3% or $3,000 upfront for placing the loan. So pre-COVID-19, 1 to 3 points was standard. Finally, the third fee lenders charge to increase their ROI are miscellaneous closing fees, or what I like to call junk fees. Now, this covers things like a doc prep, application fee, appraisals, etc. Now, this typically runs between $1,000 to $2,000 on a typical fix and flip deal. Now, keep in mind, the cost of money is weighed against the risk. So when considering the 8 risk factors discussed earlier, the lower the risk, the better the rates. For example, if a fix and flipper puts 50% down on a loan, the lender's risk is extremely low and it'll typically give a lower interest rate. Or if the fix and flipper is like me and can show that he's been a full-time flipper for a long time and has done hundreds of deals, that lowers the risk factor and will get a better rate in turn. Now think of it as a scoring system. The better accumulative score you get combining all of the risk factors, the easier it is to get a loan and the better rate and terms. Again, as a wholesaler, it's harder to wholesale deals to investors who can't qualify for funding. And that brings us full circle. Because of COVID-19, lending has become more difficult, which means it's going to be harder for investors to get funding, and as a result, harder to wholesale. Now let's consider what happened. After the stock market crash in early March of 2020, approximately 30% of hard money lenders closed their doors. They decided that the uncertainty was too risky, and rather than create stricter lending guidelines to hedge their risk, they decided to not even lend. They went away overnight. Poof, gone, just like that. That immediately put less money on the streets to go around, so naturally, demand went up with less competition, so guess what happened? Cost of money went up. Now, I think the single-digit interest rates are a thing of the past. Some of the remaining lenders that supposedly kept the doors open tightened up their criteria so much so that hardly anyone will even qualify. So in essence, they aren't really lending. The lenders that do actually want to lend money are tightening up their risk factors and increasing the fees. For example, the new down payment for many lenders is 25%. Gone are the days of 10% down or 15% down and maybe even 20% down. Lenders are getting stricter about all of that criteria, including location, size and scope of the work needed, the ARV and comp requirements, the loan to after repair value, loan to current value, and loan to capital requirements are also getting stricter. Lenders are scrutinizing even more the borrower's experience, liquidity, and creditworthiness. Bottom line is requirements to qualify for a loan are tougher, down payments are higher, and fees and interest rates are higher. Now, I don't mean to be a downer, but rather tell it to you straight so that you can get one step ahead of it right now. The reality is harder access to money creates an opportunity for you as a wholesaler and a flipper, and we're gonna see a natural decline in competition from investors that are not very well capitalized and can't meet the new lending guidelines. Remember, the cream always raises to the top. Now is the time for you as a wholesaler and a flipper to take your business to the next level. And if you know about this, it creates an opportunity for you to be proactive and find the money. So to take advantage of this opportunity, do what I'm doing. Call every hard money lender in your market and find out their new lending criteria, and then follow up monthly to make sure that you're on top of their adjustments. Now, to help you know what to ask them, I created a cheat sheet of over 20 interview questions to ask hard money and private money lenders. Now, I'll give this to you for free. Just go to myfundingkit.com. Now, once you identify the lenders in your market with the best lending criteria and rate and terms, build a strategic relationship with that lender. Find out which loan officer you can work with directly. And when you get a wholesale contract, send it to your lender contact and ask him to pre-qualify the deal. In other words, assuming the borrower is solid, would they lend on the deal, and what are their rate and terms? Once you know the lending terms and rate, take that deal to your cash buyers, and in addition to having a good deal, tell them you have a lender who's seen the deal and is willing to lend on it. Give them the loan criteria and ask them if they can qualify for those guidelines. This not only adds value as a wholesaler, but it prevents you from wasting time with cash buyers who can't qualify to buy your deals. It also will keep you at the forefront of the investment financing in your market. For example, let's say as a wholesaler, you present your deal with lending criteria to a cash buyer, and he says, I have a lender that has better criteria than your lender. You would say, is that right? Do you mind sharing with me who you're using for funding your deals? Then you would go to that lender and make them your new go-to lender. This is exactly what I did in 2010 when money dried up and was nearly impossible to get, and the few hard money lenders that were around were charging 8 points and 18% interest. So I found a private lender that had several $1 million who was willing to lend on my deals. I built a strategic alliance with him and brought him on average 5 wholesale deals a month, and he financed my buyers. Now, if you think this strategy is brilliant, leave a comment and say, Jerry, thank you for sharing your wisdom. You are a flipping genius. Here's the bottom line. During and post COVID-19, we are entering a new world of real estate investing, and those with the money are going to rule the day. Investors that are well capitalized and have access to funding are going to get the best deals. For one, I plan on dominating and making just as much money, if not more, in coming years. In fact, I'm aggressively looking for deals right now, and I fix and flip houses virtually in any market. If you'd like to get paid $10,000 for every good deal you find and bring me that meets my criteria, then register for a free training to learn all the details. Just go to my10kcheck.com. If you learned something new on this video, do me a favor, hit that like button and leave a comment and let me know your biggest takeaway. I'd love to hear from you. And if you haven't yet, be sure to subscribe to my channel. With nearly 500 videos and new videos released every single week, this is the #1 channel on YouTube for all things wholesaling and flipping, and your #1 resource for how to not just survive during and post COVID-19, but thrive. And I'll see you on the next video.